And so today with reward to risk, okay, keeping this in mind, we're going to look at a couple of different scenarios. And so we're going to start the session off just with this lesson. I'm going to give you a resource as well towards the end so that even if you don't have a trading plan, or if you are brand new to the markets and you don't even know where to begin, we've got you covered. And so you can look forward to having a template that you can easily access. You can download it, you can change it, and it's going to be available to you during this session. Now, why do I say that most people get reward to risk backwards? You know, Jordan, I'm kind of curious in your opinion, if you had to pick a few things that retail traders might do or might mess up to make them become a part of that statistic of people who lose, do you believe that reward to risk would be near the top of that list of things that people just don't put a lot of importance or emphasis on?
110%. I get asked all the time about like goals. Like what should I set my goal as far as consistently coming up with a system to go for, and a lot of people just go for pips, and no one really puts thought on following the system of percentages, because no one, like, it doesn't matter about what your pip goal is and trying to catch as many pips as you can, blah blah blah, because it's at the end of the day, it's all about how much money you're making in your account, percentage gain wise. And also following a uh setting like a certain amount of pips every time, right? And I don't agree with that either, because you got to follow a certain system, and that's what we really strive here. And I'm not for this using the same amount of pips as stop losses or take profits, right? Always going for a 20 pip win or 30 pip win. It doesn't make sense, especially when you're trading so many different pairs, or if you're just trading two different pairs. Those each pair is going to move at different speeds. It's going to have different, variations of everything. And so, sticking on the percentage mentality, that means that what you can do now is you can follow a certain percentage where you can risk, say, 1% every single time, and the variation of pips will change, right? Maybe you can have a shorter stop loss or a larger stop loss, but still you're going for the same amount of percentage risk. And I truly believe that's the only way to do it, the best way to do it. And I will stay preaching that until the end of trading time,
Yeah,
right?
I definitely agree with you there. And you said something that's really important, and I want to just kind of illustrate it for the people that are brand new. Going for a certain number of pips and using a consistent size for your stop loss. So, for example, say you're going into the markets and you're targeting to make 25 pips, or you're targeting to make 50 pips, and then your stop loss is always set at 20 pips or 30 pips. If you have a specific number that you're using, one thing that you have to understand, especially if you do start going and analyzing so many different pairs and so many different markets, is that they all move at their own speed. And so, just to help illustrate that, over here on the right hand side, we have AUD USD. We're on the daily time frame. And if we were to take a look at all of the candlesticks just from this week, so from this bearish candle right here, okay, these four candlesticks, and if we were to measure them, okay, Monday's candle moved 25 pips from high to low. Tuesday's candle was about 47 pips from high to low. Wednesday's candle was about 40 pips from high to low. And then today, we've moved about 30 pips from high to low. Now, you can already start to see the challenge if you had set something like a 50 pip take profit, because you'd be sitting in the trade since Sunday or Monday, and out of all of this week's daily candles, the market hasn't even moved 50 pips in one direction yet throughout all of this week's price action. And so, looking at some of the feedback coming through the chat, people have this tendency to get greedy. And so, even if something like AUD USD did move 50 pips, what are the probabilities that that individual as a trader is actually going to follow their rules, follow their plan, and close the trade out in profit? If we were to go and look at something like gold, okay, and if we were going to take a look at the same amount of data, this week's candles, so from this bullish one to the one that we're printing right now. From high to low, on Monday, gold moved 170 pips. On Tuesday, it moved about 100. On Wednesday, it moved about 125. And then today, from high to low, it's moved 120. We'll take a look at one more pair just to have another example. We can take a look at Bitcoin. Okay, and we'll take a look at this week's price action. So from this bearish candlestick to what we're seeing today. On Monday, from high to low, we moved about 380 pips. On Tuesday, 175. Wednesday, 160. And then today, we've moved about 600 pips from high to low. And so just by looking at a couple of pairs, AUD USD, gold, Bitcoin, most brokers are going to let you trade every single one of those pairs that we just looked at. However, we can see just by looking at the day-to-day price action that the amount of pips that each pair moves over a span of time is going to be vastly different. And so having set pip goals, in theory, it's good practice because you can effectively plan out if you're risking 20 pips and you're looking to have your take profit at 50 pips, that would work out to be a 2.5 to 1 reward to risk ratio. So it's positive. Right? You are looking to gain more than you risk. However, if you don't have the patience, the discipline, or the skill set yet to be able to discern between which pairs move more on a daily basis compared to some of the slower ones like USD CHF or AUD USD, for instance, it's going to be very challenging for you to see that consistency that you're looking for by following a specific PIP plan. The same challenge arises from having monetary goals, specific dollar amounts that you're looking for. And the reason why I say that is because no matter what your account balance is, whether you're trading with $10, $100, $1,000, even $10,000 or more, if you have the goal, say your monetary goal is to make, okay, we're going to do a hypothetical example here. So hypothetically, your weekly monetary goal is $250. You're looking to do that week after week. So for the entire month, you're looking to make $1,000 in this example for the monetary goal. Achieving that $250 week by week, you can imagine for a moment the ease of being able to do that if you were trading with an account size that was, at $100,000, for instance. Why would it be easier for you to go and actually achieve that weekly monetary goal if you were trading with a larger amount of money. Let me know in the chat if you have any ideas of why having more money in your account balance would be easier for you to be able to actually see that growth that you're looking for and to hit your weekly target if you are using money as a goal. We can ask that question, what does $250 equal in pips? And from the answers coming through in the chat, it's exactly that. Having more money in your account allows you to use larger lot sizes, and it allows you to properly plan out your reward to risk. It doesn't require you needing to over leverage to actually hit that goal. And so let's take a look at two different account balances side by side. Right on the left, we'd be looking at a $100,000 account balance. What does $250 equal in pips on a $100,000 account balance if we're using absolutely no leverage, if we're trading at a 1-to-1 leverage? Let me know in the chat if you know the lot size that represents $100,000 worth of currency in Forex. And the answer that came through about scalping, I mean, you are absolutely right. You'd be able to use, a scalping technique with a much larger lot size to actually achieve that goal. But I'm curious, I want to know, do you know what lot size represents $100,000 worth of currency in Forex? And I'll give you a minute to think about it, but it's one of the more common ones. All right, there we go. So one standard lot is the equivalent of a $100,000 account balance if you are trading with a 1-to-1 leverage. And so it seems like most people are, getting that. Most people know that that's what the lot size is. So what does $250 equal in pips if you are trading with a standard lot? Do you know how to do that calculation? Let me know in the chat how many pips $250 equals if you are trading with a standard lot position. And I'll go ahead and put it on the screen here once we get the answer. There we go. 25 pips. So trading with a $100,000 account balance, using a standard lot size, catching 25 pips, gives you that $250 growth. And so even just thinking about the examples we looked at on AUD/USD, on Bitcoin, on gold, we could see that every single day this week, from where the market started, the high, the low, and where it closed, throughout every single day from market open on Sunday to where we are right now, every single one of those currencies, as well as the other assets we looked at as well, have moved at least 25 pips. And so if you had that monetary goal and you had the capability to trade this kind of lot size without over leveraging and really pushing yourself, then yes, hypothetically, it would be a lot easier to use the right level of reward to risk, the proper risk management to actually achieve that goal. How does this change now? If we were to change our $100,000 account balance, and the reason why we used 100,000 is because that's the common demo size that you'll often see. When you open up a brand new practice account for the first time, 9 out of 10 brokers are automatically going to give you a $100,000 practice account. And so it can be very easy to see those types of gains from the dollar signs without really understanding why that's actually happening. Imagine now, within this hypothetical example, we look at the second account size and we're using $100. Okay, and so realistically, any trade size that we're taking, we are going to be using leverage. Okay, how much currency does a micro lot equal? Let me know in the chat how much currency a 0.01 is equal to in the Forex market. We know that a standard lot is $100,000 worth of currency. So how much currency is a micro lot worth? And I'll give you a minute to think about that. And then I'll go ahead and I'll put it on the screen. So yes, it is, a micro lot is 10 cents per pip. That's what the pips are worth, but how much currency is a micro lot the equivalent of? Okay, because if we think about the standard lot example, $100,000 worth of currency is equal to a standard lot. And so a standard lot is $10 per pip. If we drop it down to a mini lot, that would be $10,000 worth of currency, and every single pip would be worth $1. And so if we're looking at a micro lot, the smallest lot size, and we know that every pip is worth 10 cents, just like what's coming in the chat, a micro lot represents $1,000 worth of currency. And so if we had a $100 account balance and we were trading with micro lots, we can already see how we're starting to get into the territory of using leverage. Right? We are utilizing the leverage that the brokers make available to us. So if you have a broker that offers you 1 to 100 leverage for every dollar that you put in, they're going to match that and they're going to multiply that. And so that would give you the ability with $100 and 1 to 100 leverage to be trading micro lots with ease because you have that leverage. If you are trading micro lots, okay, 0.01s, what does $250 equal in pips now? Okay, if you're trading with micro lots, what does $250 equal in pips on that? In this example, Dimitri, we're doing 1 to 100 leverage. Before we were doing 1 to 1 leverage. There you go. So using micro lots, $250 gain is the equivalent of 2,500 pips. And so we can all agree that 2,500 pips, catching that many pips, whether that's in a day or in a week or even an entire month, would be a lot more challenging than catching 25 pips like the example we were looking at over on the standard lot. So if you had a hypothetical goal of $250 or $500 or $1,000 per day, per week, per month, while it is doable, you really have to think about how much money are you working with, because if you have that expectation of making $250 a week, starting off with a $100 account balance, without understanding the math behind how much pips you would actually have to catch without going crazy on your lot size, you can now understand how different of an approach you would have to take and how many more trades you would have to take in the market to be able to actually achieve that. And so now we know how many pips we would have to catch if we were trading with a standard lot versus a micro lot to be able to make $250 in a week. We're going to continue now, and we're going to move into the realm of percentage growth, because this was something that Jordan had talked about when he was discussing some of the key things a little bit earlier that he believes contribute to traders' success and longevity in this industry. And so, if we think about that same goal, okay, on a $100,000 account balance, earning $250, percentage wise, that's very small. That's 0.25% for that entire account balance. Whereas if we think about making $250 on a $100 account balance, that's much, much more. Right? You are more than doubling your account balance, and we're looking at a 250% growth. The number over here on the right may not seem very exciting, because you may be thinking to yourself, if I had $100,000, I'd be looking to grow that exponentially. I'd want to use large lot sizes. I'd want to trade that and use my leverage. And what's so exciting about 0.25%? When you can look at something like this and feel a lot more accomplished. Having the expectations that you're going to be able to achieve those sort of gains, more often than not, contributes to getting your reward to risk backwards. And I'm going to take a moment now to explain. Imagine you are taking the time to go reflect on your results, and you are looking at your last 10 trades. Let's say you had a 50% win ratio. 5 winners and 5 losers. Right, we could agree that 50% is reasonable. It's a very reasonable win to loss ratio. You take 10 trades, you don't know which ones are going to win or which ones are going to lose. But let's just say for this example that out of the last 10 trades, or out of the 10 trades that we're talking about, 5 of them won, 5 of them lost. For this example, we're going to use a $1,000 account balance. And let's just say that your reward to risk was set up in such a way where you were risking 1-to-1. So for every dollar that you were risking, regardless of the lot size, you were looking to make $1. Out of those 5 winners, okay, let's say that you were doing a 1% risk per trade. So you're looking to risk 1% to gain 1% of the total account balance. On those 5 winners, 1% of 1,000 is $10. So you have 5 winners, 5 times 10 positive 50. Right? Just very easy, basic math. Because 5 of those trades lost, you'd have minus 50. Let me know in the chat if you believe your account balance would still be at 1,000. Would you still be at break even after these 10 trades having 5 win and 5 lose? You stayed consistent with your reward to risk. You made $50, you lost $50 when you're looking at the actual positions and what happened. Would you still be sitting at $1,000 in your account balance? Just a simple yes or no. You would think that you would still be at that $1,000. And just like what's being commented in the chat, yes, you'd be at $1,000 because you are using a one-to-one reward to risk. This is where it gets interesting. And this is something that if you've only been demo trading, you may not have experienced yet. In Forex, when you're using a broker, you have to consider other things that, like I said, you may not have experienced yet. The probabilities of you still being at $1,000 at that break-even level after taking 10 trades, having 5 of them win, 5 of them lose, are very, very slim. It's more likely that you're going to be in drawdown and your balance is going to be below that $1,000 where you started because you have things such as swap. So if you hold your trade overnight, once New York session comes to a close, you're going to get hit with a swap fee. Sometimes it will be a positive swap and you'll earn a little bit, but more often than not, it is going to be a negative swap because that's one way that the broker makes their money. You're also going to be hit with commissions every single time that you take a trade. You're going to be paying a specific amount, and that amount is going to vary depending on the broker that you're using. And so this is going to be deducted from your balance every single time that you're taking a trade. You've also got to consider slippage, right? In a perfect world, if you had 10 trades, 5 of them won, 5 of them lost, and it took you out of the market at the exact price that you wanted to take profit or that you had your stop loss set at, that would be great. But I bet if you were to go back and look at some of your past trades and take a look at where you had your take profit level or where you had your stop loss level, and if you were to compare that with the actual price that your broker closed your position at, on a lot of them, it's going to be a different price than you originally intended. And so you're going to be experiencing a natural occurrence of drawdown because of these other factors, the swap, the commission, the slippage, things that you may not be aware of or you haven't learned yet, or you just haven't experienced it yet to even see how those things happen and what they will do to your account balance. And so even if we were following this plan of using one-to-one with 1% risk and having a 50% win-loss ratio, we can agree that in the long term, there wouldn't be growth in the account balance, right? It would either be stagnant or it would be slowly whittling down below where you first started. And that would be pretty discouraging, right? To see you're winning as much as you're losing, but you're still losing money. What's worse is that even though this is just a hypothetical example, again, most traders get reward to risk backwards because they're not even approaching the markets with a 1-to-1 reward to risk. You have some people trading with this sort of reward to risk, where for every dollar that they're risking, they're only looking to make 50 cents. And so their reward to risk then starts going into that negative territory. Have you ever been looking back at your trades and you found yourself taking 10 pip wins or 15 pip wins, very small scalp positions, and then you look at your lot size and you saw that you were risking 20, 30, or even 50 pips? That is a perfect example that most people are going to experience of how your reward to risk can start to get into the negative territory. And so if we know that a 1-to-1 reward to risk ratio isn't sustainable just by the fact of looking at the raw numbers and using a very fair win-loss ratio, then you can easily imagine how quickly you could see your account balance depleting if you are using a negative reward to risk, where the amount of pips that you're risking is greater than the amount of pips that you're looking to win. And so I want to show you now what happens if we are to maintain this 50% win ratio using the $1,000 account balance example, maintaining a 1% risk per trade at that same 50% win-loss ratio. But I want to show you what happens when we change our approach and how we look at reward to risk from negative or even 1-to-1. I want to show you what happens when you take the time to plan out your trades, just like we teach here on the Go Live sessions, and just like what you're going to see when you're looking at the bounce back sniper trades. What happens when you start looking to identify 3-to-1 setups? Same win-loss ratio, same account balance, same risk. The only difference is now you're looking for 3-to-1 setups, where every dollar that you risk, you can potentially make 3. With a 50% win-loss ratio, we know that 5 losing trades would still be the equivalent of negative 50. On 5 winning trades, however, okay, this is where things get a little bit more exciting. Because now you're not risking $1 to make $1. You're risking $1 to make 3. And so if you think about what this would be on 5 winners, okay, if we had 1% gains, we know that that would be 50. If we multiply that by 3 to match our reward to risk, then those 5 winners now become 150. And so even after we deduct the losses, after we factor in the spread, the commission, the slippage, and all of those other things that we know it now exist when you're trading and you're using a broker account, what happens now? Would you still be at 1,000? No, because you can see just by the math that the winners outweigh the losers. And so if we wanted to be fair and deduct the losses and deduct commissions and slippage and everything else, hypothetically, you could be at 10,080 or more. What sort of percentage gain is this? If we're looking at $1,000, how much percent growth from 1,000 to 10,080 is that? And you can let me know in the chat, and then I'll go ahead and I'll put it on the screen. So just like the answers are saying, this would be 8% growth. Now, even though this is just a hypothetical example, right, to help you understand the math behind how to approach reward to risk and how your results can change, when we look at hypothetical examples like this for the educational purposes, as you look at the numbers and as you understand the math, it starts to make a lot more sense of why you'd want to take that extra 120 seconds to plan out your reward to risk and make sure that your setup is at least 3-1. Imagine then changing that to 5-1 or 7-1 or 10-1. We know that we're not going to win every single trade. Losses are a natural part of the process. They're going to happen. We can learn from our losses. Sometimes we can learn more from our losses than we will from our wins. But reward to risk, when you start thinking about the importance of this and applying it to your trading, that is going to give you a paradigm shift and help align you even closer with that smart money mindset. Anytime you find yourself rushing to get into a trade, feeling like you're going to miss out, you have to take it at this very moment. If you have those sort of thoughts, more often than not, you're not taking the time to really think about how much am I looking to risk versus how much am I looking to gain. This one simple mindset shift alone completely changed the way that I look at the markets every single day. And so, what I would encourage you to do is go back, look at your last 10 trades, figure out your win ratio, and look at your balance. How did it grow? Did it increase? Did it decrease? What was your reward to risk ratio? See wherever it is that you are, and then decide where it is that you want to go. And to help you put this into practice, as I mentioned at the beginning of the session, we have a Trading Made Simple document, and you can find this in the files right on the channel. If you click on this little button that says click here to see more content, it's going to pull up something that says files and frequently asked questions. If you go under the frequently asked questions, number 3, you're going to see trading plan template. You can click that. There's going to be a link that you can copy, paste it in your browser, and then once you have it open, you're going to click File. You can either download it or make a copy. And then once you make a copy, it's going to allow you to customize it and change things to your own liking. And so inside here, you'll find some different affirmations. You'll find a trading plan and a confirmation checklist of some of the key things that we look for and some different examples. You're going to find a trading journal that you can choose to use if you like documenting when you traded certain things, what your risk was, what your trade size was, some of the key things that happened within that trade, and what the actual results were. And then we've also got a section in here for you to be real with yourself and do some analysis on how you feel about the market when you're trading. You're going to be able to find if you have that repetitive cycle of feeling like you're going to miss out on an opportunity, or if you ever find yourself feeling greedy because you saw that somebody else in the company made some money, or you saw that somebody else in the company was taking trades. You're going to be able to track and identify patterns that you may not even be aware of right now that exist within yourself that could be limiting your results that you see in the markets. And then the last category here, we've created a step-by-step, plug-and-play, easy to edit calculation where you plug in the amount of money you're trading with. And you can use this whether you're on a live account or whether you're still practicing on a demo. And I would highly encourage you to use this when you're practicing on a demo account, so that before you even decide if taking on real risk in the markets is something that you want to do and something that makes sense for you, you can already begin to build your confidence, build consistency, and build a realistic expectation of what sort of growth or change in your account balance you could see if you stay disciplined and follow a plan of action. And so you can set those weekly goals out. You can decide what ROI, how much risk. Okay, so you can have your goal over here on the left, and then you can track what actually happened over here on the right. And you can track how many pips that you are catching or losing as well. There's a section in there for that. And so I would encourage you to use this if you want to find a plan for you. This is a very great template to at least get started with. And then as you develop in your trading journey, you can customize it, change it, create something completely independent and unique that is your own. But this is a great tool to help you get started. And so that is the lesson for today on reward to risk. Like I mentioned, my whole goal with today's session wasn't to go and look at the markets together and actually mark up charts. Instead, I wanted to put some focus and emphasis on your mindset, conditioning you to get even closer to embracing a smart money mindset and perception of how you can see growth from being a market participant. And I want to thank you for being here. For those of you that were engaging with the class live, I definitely appreciate that. For those of you that went through the recording, definitely appreciate your time as well. And before we look to close off the session for today, I know that I was directing it, but I want to create some space and give you an opportunity, Jordan, to take over, add your thoughts. If you want to share your screen, you can. And then that way, you have an opportunity as well to give some more feedback and thoughts related to reward to risk.
Yeah, so I'll just make this short and sweet because this is a really powerful lesson. Just realize that you've got to make these adjustments in order to stay consistent. Like it's so true, because I couldn't tell you how many times many years ago I'd be trading something like, say, AU compared to something that moves like GJ. Okay. And even now, knowing the system to accurately place the same stop loss in the same area over and over and over again. If you don't follow working it down from what percentage you're going to risk first, right? What are you going for? Okay. And now what lot size do you need to make that percentage gain work? Right? Pips has nothing to do with anything except for getting what lot size that you want, sticking towards that same risk. Okay. And so if you don't follow this, what I'm saying, what you're going to end up using is the same lot size as you would on AU versus GJ. And now when something moves, you're going to get scared and emotional when you see it move against you in GJ versus the same thing moving against you in AU, because the moving speeds are so different that normally you would put, say, a 15, 20 pip stop on AU, maybe 10, you would do a 30, 40, 50 on GJ, depending on the type of setup. Okay. And so knowing what people feel like emotionally, if you're not used to seeing that, and if you don't understand that going prior into the trade, you are now making mistakes off of emotion because you're not used to seeing the movement. Okay. And so that's why if you follow what we're saying to the T, right, everything will start changing for you to be consistent, because I promise once you start looking at everything in percentages, then it won't matter about how many pips you catch, because you can catch 15 pips on AU and risk 5, right, and make the same percentage as if you can risk 20 and go for 60. It's the same thing. And so that's what you're doing over and over again. And that's what's going to grow your account percentage wise. Don't have pip goals for the month or for the week or the day. Have percentage gains for the month or a week or a day. Okay. And everything will change.
Powerful, powerful, powerful. And I want to just quickly add this on here to help illustrate exactly what you're just talking about. Now, these candles may look like they are the same size. We've got AUD USD daily chart on the left, GBP JPY daily chart on the right. The current candlestick that's printing from high to low on AUD USD has moved 30 pips today. GBP JPY, the same day's price action from high to low is 100 pips already. We can agree that these big bullish candles, they look like they're the same size, right? When you look at them visually, on AUD USD's chart, this bullish candle right here is 80 pips, whereas this bullish candle on GBP JPY is 375. And so really take the time to go review this lesson, review some of the things that Jordan was just sharing, as well as the plan that we laid out for you, and see how these simple shifts in your approach and mindset impact your results that you experience. Thank you again for being here. Until the next session, have a phenomenal rest of your day and stay safe in the markets.